You know, I was enjoying some peace and quiet, and then the banking system had to go and get all screwed up this weekend. Geez, can't a guy get a little rest? I was expecting some people to start reaching out to me to see what I thought about the whole thing, and sure enough, I did get a few pings. So I thought I'd take a little time and explain what's going on and what I think it portends. We'll have to get a little rudimentary at first. Hopefully, those who are completely familiar with this material will bear with me, but this is so critical for everyone to understand that I need to do it. Let's take a very conceptual look at how banks make money. Suppose you're a bank and you want to make some money over and above the exorbitant overdraft fees that you charge your poorest customers. How do you do it? Shown in red on this graph are national rates on savings deposits. So at the beginning of 2022, you might have had to have paid your customers 0.06% on their deposits in order to stay competitive and not lose depositors to other banks. Now, as a side note, the reason why so many people keep their accounts at specific banks and don't shop around for better interest rates is that it's a real pain to switch banks. Not only is there the pain of all the paperwork to set up an account, but you'd also have to change your direct deposit arrangements and set up instructions for each company that you want to pay with electronic bill payment. It's a real drag, which is why the banks have figured out that they don't need to pay much to their depositors. But I digress. So you're a bank and you have access to a bunch of depositor money at 0.06% interest. Now you know that you have to keep some cash on hand in case your customers want to make withdrawals, but since not everyone demands their cash at once, at least not normally, you decide that you can invest 90% of the deposits that have been entrusted to your care. So where do you invest this money? Generally, you'll be buying treasuries and making mortgage loans. Let's assume, for the sake of this example, that you pick treasuries, because their principal and interest payments are guaranteed. You decide to be conservative and buy a bunch of secure treasury notes that expire in 2 years. Now, you may decide to be much more aggressive, but I'm going to use the 2-year note as an example just to keep things simple. Let's suppose that you have $100 billion worth of deposits. So you have to pay $60 million per year to your depositors in interest. But since you've used $90 billion of those deposits to buy 2-year treasury notes that pay $702 million per year, you'll make a profit of $642 million per year from this investment activity. Because the principal and interest, at least in nominal terms, are guaranteed by the U.S. Treasury, you figure that this investment operation is safe. Your only real risk is that you see a heavy amount of demand requests. But you think to yourself that since you're investing the cash in ultra-liquid short-term notes, if deposit withdrawal requests are high, you can always sell some of these assets if your depositors want more of their money back than normal. But is this risk truly low? Let's take a look at that. Flash forward a year to the beginning of 2023. Jerome Powell and the rest of his merry henchmen raised interest rates at the fastest rate in history in order to combat inflation. Your $90 billion worth of treasury notes are still paying you 0.78% interest, and will continue to do so until they mature in 1 year's time. If you can hold them to maturity, you'll get your $90 billion of principal back from the Treasury. But what if you need to sell them early? How much would you be able to get for them on the secondary market? Well, they now have 1 year to maturity, just like a 1-year Treasury bill. And 1-year bills at the beginning of 2023 were yielding 4.7%. Now, nobody is going to pay you $90 billion for $90 billion worth of 1-year notes paying $702 million when they could take the same $90 billion and invest them in new 1-year Treasury bills paying $4.23 billion. That just wouldn't make any sense. What would happen instead is that the notes would be discounted. The market would pay you $86.6 billion instead, minus transaction fees and spreads, of course. So if you need to sell all of your assets ahead of time, you'll take roughly a $4 billion haircut. But as long as your depositors don't want all their money back, you can ride the problem out, waiting for the maturing loans to bail you out of a very illiquid situation. Fortunately, banking laws allow you to maintain most of your assets at par on your balance sheet. So as far as but the most astute investors are concerned, you don't have any problems. Now, I use 2-year notes here just to keep things simple. The situation for banks in general will be much more complicated, but the principle is roughly the same as it is in my example. So let's discuss Silicon Valley Bank. What happened there? Silicon Valley Bank was a bank that had as its primary customers venture capitalists and those who received venture capital money. There was a lot of hot money sitting in deposit accounts, and that money started to be drawn down as investment capital money dried up. The bank was facing a problem of illiquidity. It didn't have enough cash on hand to meet the demand of customer withdrawals. So it sold some of its securities at a loss just to come up with cash. The bank announced this loss and then reported that it would also be issuing $2.24 billion worth of new stock to shore up its balance sheet. Now, I'm not sure what the bank executives were thinking. After all, it's kind of hard to sell equity in a bank with an admitted balance sheet problem. I mean, even I know that, and I'm not paid millions of dollars each year to be a savvy banking executive. Now, the market responded quickly with a stock sell-off. People wanted out of the bank. Commentators on Twitter and Slack were quick to alert people to the problems at the bank, and depositors started withdrawing their money more quickly. On Friday morning last week, the shares of Silicon Valley Bank were halted on the exchanges, even in the pre-market. Now, I remember this because I was watching the pre-market action remotely with a friend of mine, Stacy, who's an excellent trader, by the way, and we were discussing what things might look like when trading reopened. An announcement was made that the bank was being taken over by the FDIC. It must have been a real nail-biter for the depositors over the weekend who had to wait to find out what was going to happen. Oh, and by the way, another bank, Signature Bank, was also seized over the same weekend. So what did the Treasury and the Fed do to stop a potential banking crisis that could have rivaled the one seen in 2008 and 2009? And here's where it gets interesting. They unveiled a new bank funding program titled the Bank Term Funding Program. Creative name, huh? I'm going to summarize it very briefly here. Basically, when any insured lending institution, which can be a bank or a credit union, finds itself in this situation, they can receive a loan from the Federal Reserve if they post eligible collateral. Eligible collateral is any asset that the Federal Reserve buys as part of its open market operations, and it's valued at par. The term of the loan will be at most 1 year. The interest rate on the loan will be the 1-year overnight index swap rate plus 10 basis points. And the borrower can prepay the loan early without prepayment penalty. So that's basically it. It's quite simple. The Fed comes in and provides temporary liquidity so that withdrawal requests can be honored. The collateral, being deemed safe by the Federal Reserve, backs the loan 100%. This is why the claim can be made that taxpayers are not on the hook for this. After all, the collateral being used as taxpayer obligation anyway. In the event of non-payment, the collateral, which is the taxpayer's obligation, goes poof. In fact, the taxpayer will actually benefit from this loan since the interest paid by the bank will flow to the Federal Reserve, and then the excess amount over and above the Federal Reserve's operating costs will flow directly back to the Treasury. Now, one very interesting aspect of this is how it impacts bank shareholders. Rather than being completely wiped out in a liquidation event, it's more like a slow bleed. When one of these loans is taken on, the interest paid will directly affect shareholder equity. It comes straight out of the bank profits, as it should, until the loan is fully repaid. So I don't think this was as nefarious as some people have been suggesting. I also think that it wasn't truly a bank bailout in the spirit of the bailouts of 2009, but I do think that there are some potentially dangerous implications. First, depositors have been given a clear message that FDIC insurance is no longer as meaningful as it once was. So depositors may be a little bit less careful with which banks they do business with. An unusually high interest rate might be much more tempting now, and this increases the risk that these problems will happen again. Next, it's clear that banks will not be at as high a risk of insolvency as before. The executives have been put on watch that they will be fired if this kind of thing happens again. However, shareholders may apply pressure on bank management to be more aggressive with the use of depositor funds. And this is not a good thing. Do I think that we're witnessing a new banking system collapse? No, not this time. But I do think that this new safeguard is going to lead to more fragility down the road. It's really a Minsky moment in the making. Red sky in the morning. Sailor take warning.